The risk is a deflationary spiral that collapses the banking system. Under these constraints, the rational move for the central bank is to print, but the rational move for the leveraged trader during a panic is to sell. This conflict creates the volatility trap. A counter-argument is often raised here. Many economists argue that these price drops reflect a lack of industrial demand. They say that silver is a commodity, and if the economy slows, the price should fall. This is a valid point in a normal business cycle, but we are not in a normal business cycle. We are in a sovereign debt cycle. If the price drop were purely about industrial demand, we would not see the simultaneous stress in the bond market and the repo market. The arithmetic of the debt suggests that this is a liquidity event. History shows that these liquidity crashes are often the final opportunity to acquire assets before the currency is debased to deal with the debt. The crash is the trap that separates the public from their protection. There are three possible endgames for this volatility. The first is controlled decline. This is the path the British attempted after 1931. The currency is devalued methodically. Capital controls are introduced. Gold and silver ownership might be restricted or taxed heavily. Volatility continues, but the trend is a slow grinding loss of purchasing power for the paper currency. The anchored date here is 1933 in the United States, when gold was revalued and confiscated. To stabilize the banking system, the second endgame is chaotic collapse. This is the Weimar scenario of 1923. The liquidity crunches become so frequent and so violent that faith in the currency evaporates. Completely, the velocity of money explodes. People spend the currency the moment they get it. In this scenario, the crash in silver is followed by a vertical move higher that never looks back. The price becomes meaningless because there is no offer side to the market. No one will trade real silver for paper. The third endgame is reset and restructure. This is the most likely outcome for the modern era. A new system is introduced, perhaps a digital currency, perhaps a basket of commodities. But to get there, the old debts must be liquidated. This liquidation process is violent. It involves massive volatility. It involves days where silver plunges 36% and days where it rises 50%. The winners are those who can sit through the volatility without being forced to sell. The losers are those who are leveraged. The lesson from Rome, Spain, and Britain is consistent. The crash is part of the process. It is the mechanism that clears the board for the next phase. The only variable is timing and pain. If you are watching the daily price action, you are looking at the noise, not the signal. The signal is the debt. Signal is the deficit. The signal is the history of every empire that has walked this path before. Do not be distracted by the liquidation events. Focus on the structural reality. Educate yourself on the difference between price and value. Build resilience into your personal economy. Pay attention to the data, not the headlines. Subscribe to continue this analysis.
The silver content dropped from nearly 100% under Augustus to less than 50% under Severus by the time Emperor Caracalla took the throne in 211 AD. The currency had to be reinvented entirely to hide the fraud. He introduced the Antoninianess, a double denarius that theoretically held twice the value but contained nowhere near twice the silver. This was the leverage of the ancient world. It worked for a time, creating a boom in nominal prices and a sense of easy money, but the arithmetic is merciless as the quality of the money degraded. The velocity of money increased. People did not want to hold the coins, they wanted to hold land. Grain or gold. The crisis reached its terminal velocity under Emperor Aurelian around 270 AD. The currency had been debased so thoroughly that it contained less than 5% silver. The resulting inflation was not a slow creep, it was a series of jagged spikes, flash crashes in the purchasing power of the currency. A Roman soldier stationed on the Danube frontier found that his pay, which had once bought a farm after 20 years of service, could now barely purchase a few months of wheat. The trust in the pricing mechanism collapsed. The empire didn't vanish overnight, but the economy fragmented. Trade routes broke down because no one could agree on a price. The flash crash of the 3rd century was a crash in confidence that wiped out the savings of the Roman middle class and forced the economy into a primitive state of barter. The Spanish illusion. Just like the Roman experience, the Spanish Empire in the 16th and 17th centuries faced a crisis of valuation. But from the opposite direction, while Rome suffered from a shortage of silver leading to debasement, Spain suffered from a sudden overwhelming flood of it. Following the conquest of the Americas and the discovery of the massive silver deposits at Potosí in modern-day Bolivia, the Spanish crown found itself in possession of the greatest source of liquid wealth the world had ever seen. The galleons that crossed the Atlantic were not just carrying metal, they were carrying the global reserve currency of the era. However, the Spanish monarchy, particularly under Philip II, was engaged in endless wars across Europe. The cost of these conflicts was astronomical. The incentive was to spend the silver before it even arrived in Seville. The crown began borrowing against future silver shipments, effectively creating a futures market in imperial liquidity. They leveraged their position, assuming the silver would always flow and the price would always hold, but they failed to understand the basic law of supply and demand. By flooding Europe with silver, they lowered the value of silver itself. This is known to economic historians as the price revolution between 1500 and 1650. Prices in Europe multiplied by roughly 6 times. This might sound mild by modern standards, but for a society used to stable prices for centuries, it was a catastrophe. The volatility was extreme. A velvet merchant in Seville might see his inventory double in nominal value, only to realize that the cost of bread and labor had tripled. The signals were jammed. The flash crash here was not a drop in nominal prices, but a collapse in the real terms of trade. The Spanish economy was hollowed out because it was cheaper to buy foreign goods with the abundant silver than to produce them domestically. Spanish industry withered when the silver shipments were delayed by storms or pirates. The leverage unwound instantly. The crown defaulted on its debt in 1557, 1575, 1596, 1607, 1627, and 1647. Each default was a liquidity crisis that froze the banking houses of Genoa and Augsburg. The trillions of that era, the vast fortunes of the Fugger and Welser banking families, vanished not because the silver didn't exist, but because the leverage built on top of it collapsed. The physical supply was there, but the financial claims on that supply exceeded reality. The result was a hollowed-out empire that, despite owning the mines, ended up poorer than the nations that produced actual goods. The Weimar explosion. Just like the Spanish and Roman examples, the Weimar Republic in the early 20th century demonstrates what happens when the disconnect between paper claims and physical reality hits the breaking point. The Weimar hyperinflation of 1923 is often cited, but few understand the flash crash dynamics that occurred on a daily basis following World War I. Germany was saddled with unpayable war reparations. The industrial heartland of the Ruhr was occupied by the French. The government's tax base was decimated under these constraints. The rational move for the politicians was to print money to pay the striking workers and the foreign debts. The speed of this collapse is the critical lesson for a modern flash crash scenario. It wasn't a straight line up for prices. It was a series of violent volatility events in early 1922. The mark was trading at roughly 320 to the dollar. By the end of that year, it was 7,400. But the real explosion happened in 1923. The printing presses could not keep up with the panic. The algo of that day was the telegraph and the ticker tape, relaying the exchange rate from Berlin to Frankfurt to Munich. A university professor in Berlin, selling his life's library to buy food, found that the price of a loaf of bread could double between the time he entered the bakery and the time he reached the counter. This was a high-frequency currency collapse. The liquidity in the market evaporated. No one wanted to hold paper marks for even an hour. The velocity of money went to infinity. The trillions that vanished were the savings of the entire German middle class. A lifetime of prudent saving in government bonds or bank deposits was wiped out in a matter of weeks. Conversely, those who had leveraged themselves to buy hard assets, like the industrialist Hugo Stinnes, became the owners of the country. Stinnes borrowed heavily in depreciating marks to buy mines, factories, and ships. The debt was wiped away by inflation, leaving him with the physical assets. The flash crash of the mark was a wealth transfer mechanism. It transferred wealth from the creditors and the savers to the debtors and the speculators. The chaos ended only when the currency was completely reset, but by then the social fabric had been torn apart. paving the way for political extremism, the 7 stages of collapse. The pattern repeats in 7 distinct stages. Stage 1 is sound money. The currency is backed by a tangible asset or a rigid constraint. Trade is balanced, and debt is manageable. The economy grows based on productivity and innovation. Stage 2 is overextension. The society becomes successful and ambitious obligations grow. Welfare, warfare, or imperial expansion. The costs begin to exceed the natural growth rate of the economy. Stage 3 is the shortcut. Faced with the choice of austerity or debt, the leadership chooses debt. They begin to loosen the link between the currency and the constraint. In Rome, it was clipping coins. In the modern era, it is suppressing interest rates and quantitative easing. Stage 4 is the illusion of prosperity. The easy money creates a boom. Asset prices rise. The stock market soars. Real estate becomes a speculative vehicle. The middle class feels wealthy, but the wealth is nominal, not real. Stage 5 is the peak. Volatility begins to increase. The system becomes fragile. The amount of leverage required to keep the illusion going becomes exponential. Small events trigger outsized reactions in the markets. Stage 6 is the crash. This is the liquidity crisis. The leverage unwinds. The flash crash occurs. It is not necessarily a crash in nominal prices, but a breakdown in the functioning of the market. Buyers disappear. Sellers panic. The paper claims are revealed to be worthless. Stage 7 is the reset. The system is forced to restructure. Debts are defaulted on or inflated away. A new currency or a new monetary standard is introduced. Wealth is transferred from those who held paper to those who held things. The 2026 scenario, just like the historical precedents of Rome, Spain, and Weimar, we are currently navigating the treacherous waters between Stage 5 and Stage 6. Current data suggests that the leverage in the global financial system has reached levels that make the Spanish defaults look like a rounding error. The silver flash crash scenario for 2026 is not about the metal itself. It is about the paper derivatives built on top of it in the modern markets. For every ounce of physical silver in a vault, there are hundreds of ounces of paper silver traded on the exchanges. These are futures contracts, ETFs, and unallocated accounts. This is the modern equivalent of the debased denarius. The market assumes that liquidity will always be there. It assumes that if a trader wants to cash out, there will be physical metal available or a cash equivalent, but the arithmetic suggests otherwise. In a high-frequency trading environment, algorithms manage risk by selling when prices drop. If a geopolitical event or a sudden margin call triggers a sell-off, the algorithms can withdraw liquidity instantly. They stop bidding. The price falls into a vacuum. This is how trillions can vanish in minutes. It is a liquidity air pocket. But here is the critical divergence from a standard stock market crash in a silver flash crash. The paper price might collapse while the physical price decouples entirely. You might see the spot price on your screen drop by 20% in a morning. But if you try to buy an actual coin from a dealer, you will find no inventory or premiums of 100%. The paper market crashes, the physical market freezes. This is exactly what happened in the chaotic final days of the Weimar exchange. The official rate was one thing, the street rate was another. The danger in 2026 is that the highly leveraged hedge funds and banks, facing a liquidity crunch, will be forced to sell their winning positions to cover their losing ones. Silver, often used as a collateral asset, gets sold not because it is worthless, but because it is liquid. One interpretation is that regulators will step in to prevent this. They will halt trading. They will inject liquidity. They will change the rules. This is a valid counterargument. The central banks have shown a willingness to print infinite amounts of currency to stop a deflationary collapse. However, the incentive structure suggests that their intervention will only exacerbate the underlying problem by bailing out the market. They validate the leverage. They confirm that the currency is soft. This pushes the system faster toward the inflation. Experienced in Rome and Weimar, they can stop a nominal price crash, but they cannot stop the collapse in real value. Under these constraints, the rational move for the central banks is to sacrifice the currency to save the bond market. The endgames proceed in a fixed order. First, we see controlled decline. This is the current phase. Financial repression. Inflation is allowed to run slightly hot to burn off the real value of the debt. The government manages the yield curve. Prices rise, but the system holds together. We saw this in the post-World War II era when Britain managed its war debt through decades of negative real interest rates. Next comes chaotic collapse. This is the flash crash scenario. The controlled decline spins out of control due to an external shock or an internal leverage when the algorithms amplify the move. Confidence evaporates. This matches the 2008 financial crisis or the 1929 crash, but with the added speed of modern technology. Finally, we reach reset and restructure when the dust settles. The claims on wealth are reorganized. This happened in Germany in 1923 with the introduction of the Rentenmark. Backed by land and industrial goods, it happened in the U.S. in 1933 when gold was revalued and confiscated. In this phase, the paper market is often shut down or settled in cash at a fraction of the value. While the physical assets are repriced in the new standard, the only variable is timing and pain. If you are watching this, the time to understand the difference between paper promises and physical possession is now. Do not rely on the screen to tell you the value of your labor. Educate yourself on market structure, build resilience in your personal supply chain, pay attention to the data, not the headlines. Subscribe to continue this investigation.